Hello, good morning.
Good morning to you.
Okay, I can hear you now.
Hello?
So, how is it going?
Fine.
Okay, I'm just uploading the video from our last session. I think I forgot to upload it, but you'll get it. I'll try to
Okay.
upload the one for today. This one is uploading now. You may not see that, but it's actually uploading, so you should be able to get it anytime. I will try to upload today's session as well. Now, today's discussion is very important. Today's discussion is very important because this is where you decide which type of trader you become, whether you are going to be a reversal trader or you are going to be a trend continuation trader. Like I've said before, there are those who choose to be antagonistic to the market. There are those who choose to oppose the market. There are those who choose to support the market. So that's why you can see we have reversals here, and we have trend continuation here. I can tell you there are those who trade reversals, there are those who trade trend continuation. And there are those who trade reversals successfully, there are those who trade trend continuation successfully, but the majority of reversal traders fail. I can tell you that for free. Majority of those who trade reversals fail. You must be a serious professional to trade reversals successfully. Because now remember, when you're trading reversals, you are going against the direction of the market. Now, we also need to be aware of breakouts and pullbacks. I believe we have covered this, we have covered that, we have covered that, we have covered that, and that. So welcome to these two, and I want us to clear these two. In our next session, we will talk about chart patterns, but in case we finish this early enough, we can add chart patterns so that we spend more time on the remaining things, including here where we talk about strategies, this essential part, where we talk about specific strategies to use. Okay, so we head over straight to the chart and get going. Now, when we talk about breakouts, so let's start with the breakouts and the reversals. Now, when you talk about, so our topic number one here, breakouts and pullbacks. Breakouts and pullbacks. Now, if you look at the chart, if you look at any chart, you will always see these things happen. You will always see these things happening. Number one, when you have your support and resistance zones, for now, let's leave them as levels. When you have your zones or levels drawn on the chart, you will always find prices breaking those levels. You will always see price breaking those levels. Let's see. Let me just put a few on the chart. So I've just put them roughly where I can see they're good, or like here. I believe that would be a nice place. I can even put this as a zone, okay? Something like that. Between this candle and this candle, that could be a zone. I can believe that also as a zone. Okay, then down here we have the whole of this as a zone, potentially. So let's just move the chart. Market respects that level, breaks the level, stays inside the level, breaks above the level. So when you hear of a breakout, this is what should come to your mind. You have a level. You have a level on the chart. You have maybe another level on the chart. Market was coming from that direction, maybe bounced here, went back up, came down, and went through your zone. Did not respect, did not bounce. A failure to bounce leads to a breakout. A failure to bounce leads to two things, a breakout or a ranging market. So when the market's not ranging, it will break through. Now remember, the market has only three directions. It can go up, okay? It can go down, or it can go sideways within a range. So for a market to continue going up like this, it must continue breaking levels. So in effect, whenever you hear of an uptrend, what comes to your mind? Resistance will be broken. Resistance must be broken. When you're going up, resistance must be broken. That's why we draw an uptrend like this. Goes up, comes down a little bit, goes further up, comes down a little bit, goes further up, like that, like that. So if you look at the chart, what was initially resistance is broken. What was also resistance here is broken. What was resistance here is broken. All of these are breakouts. These are breakouts happening. Okay? So when you look at your chart, for example, the chart we have, even if I were just to try to simulate it using our higher highs concept. So you will see again, this is what was happening in this chart. On this particular chart, we had this kind of arrangement. Market started here and moved like this. Up, went down. Up, went down. Meanwhile, this going up broke this resistance here. Can you see that? There was a breakout here. This was a breakout happening here. When a market goes above your resistance level, it's a breakout. When a market closes below your support level, it's a breakout. So let's follow that. Market now started consolidating around here. You can see that clearly. Then decided to go up to where? Same level. That is not a breakout. Then came down, but then broke that level here. Now you can see a breakout there again. There's a breakout here. Okay. Then what do you see next? What you see next is market continues and consolidates here. So let's pick another chart, a downtrend here. We see market doing this, starting here, coming down, going up to that point, coming down, going up there, coming down here, slightly up, slightly down, slightly up, further down, up, down, up, down, up, down, up, down, maybe up and down. Okay, so now let's pick the corresponding breakouts where the market was not respecting those levels. This was a support level. Market broke it here. It's a breakout to the downside or a bearish breakout. This was a support from here. Market broke with this candle. If this was your support, this candle broke your support. If this was your support, this candle broke your support. All of these are cases of what we call breakouts. 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 Here, a breakout also. Here, a breakout. Here, a breakout to the upside. Here, a breakout to the upside. So a breakout is simply when price moves above your trading range or above your zones or below your zones. So with resistance, if you see a candle, so this bullish breakout, if you see a bullish candle close above your zone, close above your zone, let's say you are drawing this as your resistance zone, like this, and a candle has closed above your zone, this is considered a bullish breakout.
Bullish breakout.
Bullish breakout. Because who have broken this level? They are bulls. Buyers. Yeah. So this is a bullish breakout. Bullish breakout. Now, if you had a level like this, and you saw a red candle cross below, cross and close below the zone, this is now what we call a bearish breakout. Bearish breakout. Because the breakout has been caused by bears. Okay.
Is there a point that is there a point that you can have the two?
Is there?
Is there a point that you can have the two?
Is that a case where you can have the two?
Yeah.
Are happening at the same time?
Yeah.
No, it's not possible to have the two at the same time.
Mm-hmm.
It is not possible to have the two at the same time.
But right now this point
Yes.
of 15th August.
Which one?
16th hour.
I can't hear that.
And I'm talking of 5th August.
Mid-August.
On the chart.
Yes.
On the chart, yeah. 5th August on the 16th hour.
Okay, what I'll do is let me share with you my allow you to use your mouse so that you can point what you are saying on the chart. So I've allowed you to use your mouse so you can move on the screen.
Yeah.
Okay, so move the chart if you want with your mouse.
Pardon?
You can move the chart or you can draw something on your on the chart now.
Are you seeing me?
Yeah, I'm saying just draw something. I want to see what you're talking about. Yes?
Yeah.
There.
Yeah.
Mm-hmm.
What is that?
The one you're pointing at?
A.
I don't know. I'm just seeing a candlestick pattern.
I know. Is that a point?
A point?
No. Is it a breakout point?
I don't see a breakout at that point. No. Because just leave the mouse alone for now. This is your resistance here. This was past resistance that has become support. There's no breakout here.
Yeah, on that support.
But now there's breakout here.
Oh, okay.
And if this was support, there was a breakout here.
Okay.
I mean, breakout has to happen with a candle closing outside below your level if you are at support. So like you have drawn your support here. If this is your support range, you know, like I like drawing a zone between the body and the wick. So if the whole of this represents your support, this candle has broken through the whole range. So it's a breakout, a bearish breakout. So for a bullish breakout, assuming this was your resistance here, and you can even make it a zone, all of it between the wicks and the body, this candle managed to break and close above the whole zone. So this is a bullish breakout.
Okay.
Fair enough?
Yeah.
All right, so now you need to know how to approach breakouts because there are people who trade breakouts and there are people who don't trade breakouts. So I will show you a pullback and I'll show you a breakout and then show you which is better to trade, okay? For example, if you look at this trading range here, if you see this trading range between this candle, this is where the bearish candle stopped. We have this bearish candle and this one, and the wicks. So I tend to treat this as a complete trading zone, this one, okay? And you can draw it differently. If you go back, you can see something similar to that. But assuming this is a trading zone, yeah, a support zone, this candle breaks below, market comes back into the zone, finally breaks out of the zone. Now there are people who will trade here. There are people who would enter their trade here after this candle. You see this candle break completely outside this entire zone, they'll start selling. Now, if you trade like this, you are considered a breakout trader. Even those who trade on this candle, just this candle, they see a candle break their support, they sell. They see a candle break their resistance, they buy. Those are breakout traders. I'll give you another example so that is much clearer to you. Let's go to a different time frame. Here could be another example for a breakout trader. Consider this as your resistance zone. Resistance, resistance, resistance. Quite a number of cases where you can say that's resistance. You can even make it a complete zone. by including this range from here to here, so that you take care of these candles and you take care of these wicks. So there are people, the moment they see a candle close outside that zone, which is which candle? This candle. This is where they buy from. At that point, these guys will buy. They enter buy order here after the close of this candle. Surprisingly, there are even those who trade before this candle closes. Okay.
Yeah.
So that is what is still called breakouts, breakout trading, breakout trading. Now, I do not recommend trading breakouts in that manner myself.
Okay.
Why? I'll show you exactly why that can destroy your account quickly, very, very quickly. Okay, so over to the charts. I'll give you several examples where this can roast you. You believe this is a support, correct? This is support. Market came back 3 hours, actually 12 hours because we are on 4-hour time frame. Market came down for 12 hours. Each candle is 4 hours, stopped here and went back up. So you mark this as your support area or your support zone. You saw this candle breaking this support live when the candle is forming. And because you believe in breakouts, you enter a sell here. Okay? Sell. Now, immediately you sell, the candle closes nicely down, but the next candle goes up, the next one goes up, and you continue going up. And if your stop loss was somewhere here, you're already out. You've lost that trade. That's case number one. Let's move to another place. You will see numerous examples of this. Now, you also, maybe you saw this one happen here. You believe that was a very nice resistance or support. Can even try it here, but for now, let's keep it here, okay? You saw that rejection, rejection, rejection. Remember, we said that a nice level has had multiple rejections before and multiple touches. So it looks a very nice resistance. And here you go. You see the market coming back and closing above that level, and you buy. What happens? Market doesn't move far. It dives back down and you lose your trade. Okay? Now, that is case number one of those who trade breakouts in that manner. Now, there are those who trade breakouts after the candle has closed. They also fall in the category of those who lose. Many times, so for example, they would see this one as a resistance zone, this area. Consider that this candle went up and stopped for 4 candles, went down, so this became resistance. This candle is the breakout candle, this long green. So after it has closed up here, up here where it closed, they'll enter a buy. They'll buy because now they know we have broken resistance, we can continue going up. But what did you see the market doing instead? Market does the exact opposite, and the stop loss hits. You can see the same thing here. Support is broken, market goes back up. There I can show you example after the other, where the market does things the way it wants, not the way we think it should. Now, so when you hear of breakout trading, this is how you should look at it. You have a level on the chart called resistance. You see candles going up like this. Sorry. You see candles going up like this. After this is another one. After this, you see something like this. This is a sign, this is a breakout itself because we have closed above our resistance. Now, there are people who buy here. There are people who buy there, definitely. So this becomes a buy signal. Either when the candle is already breaking through the level, they can see it going above the level, they buy, or they wait for the candle to close and they buy. So this is breakouts. This is trading breakouts. And that's how some people trade breakouts. Now, I don't recommend this method at all. The opposite of that method would be you have a support level down here and you see candles coming. first candle here, maybe there was another candle here, and you see another candle going and closing right below, and you sell. I also don't recommend this. Why? We have clearly seen that after breakout, the market reverses many times. After breakout, you break resistance, close above resistance, there is a possibility market will go the opposite route. So how then do we do this? How then do we trade the market? Because we sure know that market will always go up, go down, go up, go down, go up, go down, go up. So how can I ensure I trade here after it has gone up? After it has gone up, so that I can follow it, okay? One other recommended way of trading a market like this is to use the concept of pullbacks. Pullbacks, or pullback trading. Pullback, two words combined, pullback. Pullback is also what we call retracement. Retracement. And this is where we have been using Fibonacci a lot, retracement. So let me show you what that should look like, okay? Market goes up, comes back to a certain point. Market goes up, comes back. Market goes up, comes up, down. Market goes up, comes down. Now, this is an uptrending market. Now, what you need to realize is a number of times, what was initially the high, market will come back to that same level here. If you look at this point, market is likely to come back to that same level. Or market will come back to the same level and you can buy again. So if you want to be a better trader, this is what you need to do. Don't trade immediately. Don't trade here when the breakout is happening. You trade when market comes back to the same level. You wait for it to break out, go away, up, but then come back to where the breakout happened. Then you can look for a signal to buy. Wait for it to break your resistance, let it go up, come back to the exact same level or very near to the same level and give you a signal, then you can buy. So if you are buying at this level, you are a pullback trader, a trend continuation trader. You are a trend continuation trader. If you are trading exactly here, you are a pullback trader. You are a breakout trader. All right? Now, the reason I prefer this, and the reason many experts will tell you this is a better place to trade is, this is the logic. If the market goes up, comes down, goes up, and comes down to the same level, we expect it to respect this level. Now remember, broken resistance becomes what? Support. Remember that concept?
Yeah.
Yes. When we break our resistance line, this one, and come back to it, it should work as support. What did I say we do in an uptrend? We only buy, correct? Yeah. But where do we buy?
At support.
We buy at support. In an uptrend, we buy at support. In a downtrend, we sell at resistance. We sell at resistance. So when you do this, when you wait for the market to break resistance and come back to support, you are actually following that logic of buy low, sell high. Support is the lowest level in an uptrend. So you are buying low. If you are moving down like this, in a downtrend, market fell, came back, fell, came back, fell, came back. So you are now, what was initially support is resistance. What was initially support here becomes resistance. So here, you will be selling at these points. You are selling at now resistance. In a downtrend, you are selling at resistance. This is what we call sell high. Sell high. If you are a seller, you would like to sell at the highest price.
Yeah.
If you are a buyer, you would like to buy at the lowest price, correct? So in an uptrend, you don't buy here when price is already high. Because when price is high, you expect it to fall. You buy when the price has come down, like a discount, and expect it to start rising again. If you are a seller, you wait for price to go up. You said when you think the price is becoming, people are not interested in the very low prices, you wait again. Market goes up, gives you a better price, you sell again. You hold your goods. When market prices jump up again, you sell again. So that's what you do. So let me show you what exactly that mode of trading looks like. A good example is already here. Market is moving up. Market is moving up. Breaks the first support or the first resistance here. You can see that. Breaks above it, comes back. What kind of candle do you see here? A rejection candle with a long wick, followed by engulfing. This and this will give you an engulfing you can consider for a buy setup. Happening at support. Now remember, it was initially resistance, was broken, market has come back. Same thing happens. This is your resistance. Okay. Market breaks above it, comes back to the same zone. What kind of candlestick pattern do you see here? You can call it a morning star if you take 1, 2, 3, or you can call it bullish engulfing if you take 1, 2. That you can buy once again. As opposed to initially buying at the close of this candle, when market actually went back down and hit your stop loss. So this will be a losing trade actually. But this is a winning trade from here. Another example. Now, when you do this, when you trade here, you are a pullback trader. This is what we call a pullback. When market comes back to a level it broke, it is pulling back. It is a very common phenomenon on the chart. Very common. Look at the chart here. Here. If you consider this was a previous support, market stopped here, market stopped there before. After breaking this level, you see it coming back exactly to the same level. This is a pullback. The act of market breaking out and coming back to test the same level. People will say that's, other people will call it a retest. The market is retesting. So you see a market that goes like this, breaks, comes back, and then continues. We call this a retest. It just tested that the level it broke was strong enough. So we call it a pullback. We call it a retracement. Some people call it a retest. Okay, a retest if it goes back to the exact level. A pullback, maybe it will stop somewhere before reaching the level. But in short, what you are saying, it's much better in an uptrend to always trade in this manner. I will draw now like that and try to create it in a manner that you can visualize easily. When it goes up, it creates a high, comes back down, goes further up, creates another high, comes back probably to the exact same level here, goes further up and comes back to the same level. Sometimes it will go up and never come to the same level and continue, okay? So sometimes it will give you pullbacks, sometimes it will deny you pullbacks, there's no problem. So that's your first pullback area here. If the market ever came back to this line and they gave you any buy signal from candlesticks, you can buy. If it ever comes back to this same level, remember it was initially resistance. If it ever comes back to this level and give you a candlestick pattern that you can follow, which is bullish, something like a morning star, bullish engulfing, bullish harami, pin bar, piercing line, any of those, you can buy again. Here, it did not come. So there's no problem. You miss an opportunity once in a while. Maybe here it did not come. Maybe later it will come. You get the logic. So when you are actually buying at these levels, when you are buying here, waiting for market to come back to a level that it broke initially, you are a pullback trader. And this is what we call trend continuation. Trend continuation. Okay? If you are moving down, now let me draw that. You're moving down like this, and the market does this, tries to go back up, breaks further down, okay, goes somewhere there, then goes further down again, goes back there, goes further down, something like this. You will notice this was your resistance, this was your support, sorry, all those are support levels. So if you are a pullback trader, you will not break here, you will not trade when market is breaking your support, you will wait for it to come back to your support here, then trade. You will not trade when the market's breaking the level immediately. You'll wait for the market to come back to your level, and you'll place your trade. So you'll place your trade when the market is coming back to the same level. Now, that's when you become a pullback trader. Market ever comes back and gives you a signal there, you can exactly do the selling. Now, we have put a lot of things together from since you began your classes, and now you can start seeing how these things are working together. Let me show you a good example, for example, here. But before I do that, I also need to introduce the concept of reversals and pullbacks. Reversals and continuation. That is what we needed to talk about. Reversals and trend continuation. Now, when I look at the market, there are two things happening. The market will either continue or will change the direction. For example, I know this is resistance. Market was coming from here. All right? Market's coming from here, it's going up here. There are people who will place their trades here to sell. All right? There are people who wait for the market to break above the zone, come back to the zone to buy. Interesting. There are people in the market doing one thing or the other. Now, this person might be trading because of support and resistance only. This person was taught, if market comes to resistance, sell. If market comes to support, buy. Okay? This other fella here has seen one thing, for example. In fact, here, someone would be selling here, exactly here. Why? This person has seen resistance here, has seen the resistance here, and they knows now resistance that have been tested twice is stronger. So they will say, if a candle comes to this place, they will place an order before the candle closes. So immediately the candle touches here, they are in a sell trade. There's another person who will say, okay, I have noticed one thing in the chart. I've noticed that, let me show you what I've noticed. A better trader would have noticed this. Someone would have noticed, okay, the market made a low, went here, came back and made a low, but now this low is higher than the previous low. Yeah. And that is an indication of what? An uptrend. Now remember, in an uptrend, this is what we call an uptrend. I'll write this again. In an uptrend, you will only see the market making higher highs and higher lows. In a downtrend, you will see the market making lower highs and lower lows. All right? So number one, if you were to analyze this market so far, you would have spotted one thing. Remember, you're analyzing using the past. So the market came from here, at that high, had that low, had that low, had that low. You get, so the market was coming from a downtrend, making a lower high, and another lower high here, while it was making a lower low, another lower low, same low, now another lower low. But for the first time, you see the market making the first higher low, okay? But now if you consider the lows in general, you'd see this low is still higher than the previous low. So this is a higher low. What about the first, this one? This high is higher than all the highs. Surely, this must be an uptrend starting. So it will be not proper. It will not be proper to try to sell here. Because when you are selling in an uptrend, you are a reversal trader. You're trying to reverse the uptrend into a downtrend. And when you're a trend continuation, you spot an uptrend, you buy in an uptrend. You spot a downtrend, your business will be to sell. So you see, immediately these people try to enter their trades. This guy is roasted because the market does not respect that. It continues going up. This guy who waited for the market to break up to confirm the uptrend is becoming strong. Market came back to the same level, gave a morning star. This guy bought and the market went up. So in short, if you see a market that looks like this, you see a market that looks like this, and we are coming from a downtrend, This is a downtrend. This is what you should do. Market might just do this, do that, do that, do that, do that, then maybe break. So because we know this is a downtrend, even when you see the market coming to this level, remember it has created support here. Don't try to buy here. Why? We are still in a downtrend. You are better off selling from resistance. You could sell from here. You could sell from here. Or you could wait for it to break your level, come back to the same level like we said, and you enter your trade as a pullback. That's now when you are a better trend following person, not a reversal trader. Now, let's introduce our moving averages to visually show us an uptrend. I know we still can draw we can determine the uptrend without necessarily using those moving averages, but let them visually help us out quickly. We have our 100. So the line is too thick, I think. We have our 100 EMA and our 50 EMA, exponential moving average, those two. So clearly this is an uptrend, all right? This is an uptrend. Now, this is what a reversal trader would do. A reversal trader, once that person has support and resistance on the chart, when price comes to resistance, they will sell. So market comes here, they sell. But you see they are selling against an uptrend. Yeah, they are selling in an uptrend because clearly it's an uptrend. So when you try to sell here, you are a reversal trader. When you try to look for places where you can sell, like you spot this as a minor resistance, when this candle is trying to break, you sell again. Now that is becoming a reversal trader. A good trader would do this, would wait for the market to break above this level, come back to the same level like a pullback, give you a signal, and now you can consider buying from here. Why? You are buying because you know the uptrend has power to continue going up. Clearly, you can see there is a high, which is higher than this high, which is higher than this high, which is higher than this high, and that's how an uptrend forms, higher highs. You also see the market break, create a resistance here, and then close above it. Comes back and gives you another signal there. See that? Breakout, pullback. Breakout, pullback. Pullback trades are the best you can have from the market, in my opinion. They're the best you can get from any market, pullbacks. If you are in a downtrend, you wait for the same thing. Let the market break and come back to the same thing, or at least come back to your resistance. Remember, in a downtrend, we trade a resistance. So initially, there was resistance here. Market has come back to your resistance here. You have a shooting star, you can sell. You have this bearish engulfing, you can sell. You can combine this and this to create a dark cloud cover, you can sell. You are selling at resistance in a downtrend, that is selling high. Selling high. This is what we call selling high. This is what we call buying low. Buying low. But if you are trading directly on the market is breaking out like here, you are buying high. You are buying high. If you try to trade here, with the market within this candle like this, you see the candle breaking support, and you're selling from here. Those are breakout traders who sell from here. You are selling low. And when you are selling low, you expect market to go up. Okay? Look at how pullback trades are very strong here. Resistance zone here. Market breaks above it, comes back, gives you a bullish engulfing pattern here. Market goes up. But there are those who might have spotted the resistance here. Let me tell you, like there are those who spot a resistance, and all they do is just try to stop the market. This is a resistance. Market comes back to resistance. They sell. They immediately lose the trade. Why? They are trying to reverse an uptrend. The uptrend is still strong. We still have an uptrend, so you are trying to reverse, because by selling at resistance in an uptrend, you are trying to expect the market to go down. But the market has power to go up, not power to go down. In an uptrend, buyers are strong. Bulls are strong. In a downtrend, bears are strong. Bears are strong. So that's why we always say go with the flow. Go with the flow. That's a phrase. Go with the flow, or go with the trend, or what people now generally say, follow the trend. Follow the trend. Don't fight it. Follow the trend. If the market is up, buy. If the market is down, sell. Simple, and avoid losing money. I hope you're following.
Yeah.
Is the understanding between these concepts now clear? Is it clear for you? The breakout compared to a pullback, a reversal compared to a trend continuation. Great. I think either we stop or I show you divergence trading.
10 or 9?
Either we stop because we are done with the business for the day, breakouts versus pullbacks, reversals and trend continuation. Either we stop there because we have completed our objective for today, or we continue to the next topic.
Let's continue.
We continue to the next topic, or later, maybe.
We can continue now.
Okay, not a problem. Now, if we continue now, I will show you chart patterns, effective chart patterns. This is supposed to be a trading methodology on its own. I just introduced it because you are most likely going to come across chart patterns. But chart pattern trading is a concept that is on its own. It's not necessarily part of price action. But I know price action traders also look at chart patterns, so I thought it's important to include it in the course. So when you hear chart patterns, let me show you what I'm talking about. You already have this book. I'm just opening from the one I sent you. Okay? If you look at this book, this is a very important book for your information.
It's a very good book, by the way.
Sorry?
It's a very good book.
It is a very good book. So if you look at chapter 9, I believe, profitable chart patterns. Profitable chart patterns, chapter 9. Now, if you look at this book, we have some patterns that are formed on the chart. Some patterns are formed on the chart that can be traded on their own. Remember, we have two things that use the name pattern. We have candlestick patterns. Candlestick patterns are patterns formed from candlesticks. 1, 2, 3, around 1, 2, 3, or 4 candlesticks. But when you hear of a candlestick, when you hear of a chart pattern, a chart pattern is a geometric shape. It's a geometric shape formed by candlesticks on your chart. Usually, very many candlesticks are involved in forming a chart pattern. They are geometric shapes. Geometric shapes, for example, look at that. That's a triangle. A triangle is a geometric shape, okay? So they are simply geometric shapes formed by candlesticks on the chart, and those shapes can help you determine where the market is moving to next. They can give you opportunities to trade. Now, a very popular shape, a very popular chart pattern is a triangle. A triangle. Now, a triangle, as we know, has 3 sides, correct? So we will assume one side where the market is coming from, but we'll be creating 2 other sides. So if you look at this shape, you don't add a line here. The candles are assumed to be filling this line, but otherwise we have those 2. So we ignore this, there are those 2. That's still a triangle. Now triangles are of of 3 types. We have one called symmetrical. A symmetrical triangle pattern is one where we have resistance that is sloping down and we have support that is sloping up at nearly the same angle. So coming down, coming up. So this is when a market is getting into a ranging zone. The power to go down and the power to go up is the same. You see, they move down 2 candles, they go up 2 candles. 1 candle, 1 candle. So as they get very squeezed together, symmetrical pattern. Now, in most cases, if when you spot this kind of pattern, the breakout can happen to the upside or it can happen to the downside. Because when market get congested like this, it must break out and start going up or break down and start going down. In most cases, if you were coming from a downtrend, like this, the breakout will be to the downside. If you are coming from an uptrend, before the formation of this is what most likely will happen. However, you don't predict. Let it happen, and then you follow the breakout. If the breakout is to the downside, follow the downside. If the breakout is to the upside, you will follow the market to the upside. Now, like here, this is one called ascending triangle. Ascending in the sense that resistance is horizontal, but support is ascending. The support trend is a trend line. We drew trend lines last time. So you can see what you're seeing happening here is so simple. This candle touches here, this one touches here, this one touches there, they touch. You are able to connect those touches. Connect, they give you that line. You can see all the candles are touching the line, almost all of them. So you create a resistance. But the resistance is horizontal, the support is rising. So this is why we call an ascending triangle. A number of times it is believed that when you have an ascending triangle, the breakout will occur to the upside. Like this candle breaks up above that resistance, then you continue trading up. As usual, don't just believe that. If the market breaks to the downside, follow that route as well. The opposite, if this was ascending, this is descending. Now in descending, your support is horizontal, but your resistance is sloping down. And as you can see, candles are touching everywhere. So market is believed to break to the downside, but it can still break to the upside. So be aware, don't just follow textbook signals only. So let's go to the chart and identify some of these patterns so that you're able to be familiar with them. Okay, so on the chart, you will start seeing these things. They are there. I will show you. One, resistance, resistance, connect. What is happening down here? Support, support, support. What example of a triangle is this? Descending, descending, descending. Your support is flat, your resistance is sloping down. Okay, let's move on. What about what I'm seeing here? Touch, 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 touch. They are moving together. This is the first one we saw, symmetrical. Okay, so like I said, in most cases, if you are in an uptrend, it will break to the upside to continue the trend. But sometimes it can break to the downside. So just wait until the breakout occurs and a pullback happens, then you can trade. The other one is which one? Let me so that I can see one that can serve as an ascending triangle. Ascending triangle will be found in a downtrend or where? Let me see. Ascending triangle, if I can spot it. If you see one, you can let me also know. It's a nice symmetrical one. It's a symmetrical one. Very nice. Touch, 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 touch. And this one also. Same thing. Touch, touch, touch. Wow. Symmetrical. And because of that, you can only see where it broke to there. So broke down and went down. No. Ascending triangle. Is this one? No, this one is just going the other routes. We don't have such kind of things. They all must converge together. The lines must be coming together. That one, they are going away. That one, they are going away. I think an ascending can be drawn here because we have a resistance here. Resistance. You can agree with me that's a resistance from here. Market reverses, 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 reverses all the way. But from this other side, what we have is this. Okay, that's what I can see. Market is ascending, so it's an ascending triangle. This one. All right, so you can study. So when you want to trade these patterns, you wait for a breakout and you determine the next level where the market will stop from. For example, this is a breakout. If you want to trade that breakout, you can imagine from there. So you can take the height of the triangle, and that becomes your take profit. So if the height is 43 pips, after the breakout, you close your trade 43 pips down. For the one we drew where? For this one, after the breakout here, you measure the highest here, 43 also. So after the breakout, your target should be 43 pips. This one did not give you 43 pips, gave you 38 pips. For the other one we drew somewhere, or I deleted it, I don't remember. Maybe I deleted it. Oh, it's here. For this other one, the breakout happened to the upside. So the height of the triangle was around, why is that every time it's 43 pips? Mysterious. So breaks above this, and you can target 43 pips, which I think you got at here. But most likely, you would have been out by that time because it went down before going up. So this would be a losing trade, actually. All right, so those are the shapes. Now, those are called triangles. They are generally called triangles, and they are of three categories. Triangle chart patterns are symmetrical. We have seen that, ascending and descending. Now let's look at head and shoulders pattern plus the inverse head and shoulders pattern. Now these are very interesting. They just look like the name says. They look exactly the way the name reads, head and shoulders. Now, how does that look like? Head and shoulders looks like this. Market goes up, comes down, okay? Goes further up, comes down to the same level, goes slightly up, comes down to the same level, and eventually breaks through that level. Now, shoulder number one. Head. Shoulder number two. Neck. That's your neck. Okay? The shoulder is always below the head. The shoulder is always below the head, shorter than the head. So this is your head. The first shoulder, the second shoulder. Now, a number of times this chart pattern would form, especially in an uptrend. The market has been moving up. Market has been moving up. So it makes a high, this is a high, and makes a low. All right? Goes up and makes a higher high, but makes the same low. Remember, this low is the exact same low. Now, remember, in an uptrend, if we make a higher high, we should also make a higher low. But that's not happening. Now, to make it complicated, it still goes back up, makes a high, but now this high is a lower high. This high is lower than this. Clearly, the uptrend is dead. Because an uptrend should be this. That is not happening now. It just went up, came down, went up, has come down, now has gone lower. Clearly. And it has been violating in all those three cases. From here, it made this high, made this low. It has made this high, it has made the same low. It has made another high, it has come back to the same low. Something is wrong. So how do you trade this? When the market breaks your neck, when the market breaks this neck, you enter trade. You sell. And your take profit would be the distance between this place and your head.
The head.
Yes. And your stop loss can be above the shoulder. Here. You put your stop loss here, you measure the distance here, you push it down here as your take profit. And your stop loss somewhere here. There are those who are aggressive, who are interesting, they can put their stop loss here. I don't recommend that. That will be a big stop loss. So let's see this on the chart so that you know we are talking about the same thing. I see one here immediately. I don't have to go far. You just need to have a good eye. Market has been moving up, makes a high, comes down, goes up, comes down to the same level, goes up, comes down, and breaks through that. So my neckline is here. First, shoulder, shoulder number 1, shoulder number 2, head, neck is the neckline. Immediately the neckline is broken by this candle, you sell. Your distance from here to here, measure the same distance from your breakout, from this place, push it down somewhere there. This is where your market, this is where your trade should end. That's where your trade should end. So for example, if this from here to here was 48 pips, you also measure 48 pips downwards. So somewhere here. Your stop loss, somewhere here. So if you above the shoulder, so you measure your stop loss, that should be 27 pips, which is fair enough. Your stop loss is almost half your take profit or thereabout. So that's head and shoulders. It's being described here also. So it's in the textbook. I think you can get a number of examples here. Head and shoulders. Where are you? Here. Shoulder now, left shoulder, head, right shoulder, or shoulder 1, head, shoulder 2. Neckline, breakout, and that's how you trade. So if you look at how to enter the trade, I think there's still another example. Shoulder 1, head, shoulder 2, neckline, you expect a breakout. So when the breakout occurs, that's where you trade. And about stop loss, you see, above the neck, above the one of the shoulders, the last shoulder, above the last shoulder, you put your stop loss. You go short, immediately you break the neckline, and then, or if the market ever pulls back to your shoulder, look at that. Let me give you that. If after the breakout, if after this breakout, if let's say the market went down slightly and then went back to the same level, that would be a pullback. This is resistance. The neckline is resistance because it was support. That's why it stopped the market here, stopped the market here. Now it has been broken. We know broken support is resistance. So when market comes back to the neckline after the breakout, this will be a pullback trade. Look for a signal here to sell, a bearish pattern, a bearish candlestick pattern to sell. But sometimes it will break and continue just like that without a pullback. Okay. All right, then they're talking about you can go short here immediately at the breakout, or you wait for a pullback trade, you go short. Okay, and you see they're explaining how you can calculate your what, how you can calculate. You see, from head to neckline, that is the target. Count from the breakout area to the downside, just like I showed you, from here to here. So this distance is also the distance from where the breakout occurred to where your trade should close. That's how we trade this. So that is that. Maybe you can see another one on the chart, a second example. We stop there and then we move to another pattern. Because there are 9 patterns. There are 9 chart patterns I want to show you today. Head and shoulders. You will most often find it in an uptrend, but you can also find them in a downtrend. The one that looks quite clear. I think this is almost one, but not the kind of okay, maybe 15-minute chart and give us that. No. Okay. I don't think this is one. Always recommended, even when you are trading these chart patterns, trade them in the direction of the trend if possible. So let's see. Am I seeing anything here like looks like one? I'm sure they're there, but I'm scrolling too fast, so I may not be able to spot them. Let's go back to 4 hours chart. You might see one. And indeed, there's one here. Something that looks like a neckline to me. Yeah. As you can see, the market went up. Market came down, stopped here. Market went far up. Market came back to the same level. Market went up, but slightly lower. And then the market broke through your zone. And interestingly, this one came back to the zone. Okay, beautiful. That's a nice one here. So shoulder number 1 here, left shoulder, right shoulder, your head. Now you trade your first trade here, enter your first trade at the breakout. When you see the breakout and the close below the neck, you can enter trade. Or you wait for the market to pull back and come back to your zone. This is a pullback trade. And it gives you a signal. You see something like bearish Arami here, you can sell from there. So how do you manage your trade? In this case, you needed to just measure from here to the head, 173 pips, 176 pips. Then you measure from where the breakout is to occur, 170 something pips. Somewhere there, 76. So ideally, you place your target here. So breakout, your target is here. Or a pullback, your target is down here. Stop loss, here, above the shoulder, here. How big is your stop loss from the breakout? About half. 71, the other one was 170. It's actually, this is a very good trade, actually. Because you have 70 pips stop loss, you have 170 pips take profit. That's more than 1 to 2 risk reward. Very good. So that's head and shoulders. Now the opposite is also true. You can have an inverse head and shoulders. The market's coming down, comes up to a level, goes further down, comes back to the same level, goes slightly down, back to the same level, and then breaks. So you have shoulder 1, you have your head here, you have another shoulder here, you have your neckline here, market breaks above your zone, you buy. Keep the same distance, head and shoulder, head and the neck, measure the distance, that becomes your target. Your stop loss below the shoulder. Just the opposite, the reverse, it's inverted. I believe you can see that, but let's try to spot one so that you know it's, you see it in your mind. I believe this could be one. It's one. They don't have to be picture perfect. You see, that's a problem some traders face. They want things that are picture perfect. We are coming from a downtrend. We make this swing, go further down, make that swing, go slightly down, make back that swing. Does it look like an inverted head and shoulder for you?
Yeah.
There's a neckline here. This candle breaks above. You buy from here. How do you manage it? This is the distance between this line and this place. That is you measure the distance in pips. So from the breakout here, you measure that distance. It could be around here. So that's your target. This is your stop loss below the shoulder, the last shoulder, just like that. So that's how you deal with inverted or inverse. It's called inverse head and shoulders pattern. I believe you understand it. I don't have to use another example. We need another example. Okay, for your benefit, if I give you another example, I guess. Quickly see whether we can spot one. Doesn't look like a very nice one. This one doesn't look like a clear inverse. It's called inverse head and shoulders. Inverse. Right. This one looks like one, but not a very good one. And about this one, no, not wait, not that. That chat has gone mad. So let's go to 5 minutes just to get the illustration. I don't trade on 5 minutes when I'm doing Forex.
Is there a tool that can assist you to get the pattern?
That can identify them.
Yeah, a tool.
Yeah, there are software that can identify these things.
Oh, okay.
Yeah, there's software that can identify these things for you, but they may not be able to identify them accurately. That's the problem. You know, computers have limitations.
Mm.
Yeah, they may not be able to identify them accurately, but they can give you an idea. I want an example, a final one for now. Oh. I'm seeing one. I don't know whether that is what you are seeing also, but I'm seeing one here. A neckline. Move down. Move up. Move down. Create the head. Move back up. Move down. Create the other shoulder. Move up. And breakout. That is an inverse head and shoulders.
Mm.
This one fortunately went up and gave you a pullback and gave you a signal here, something that looks like a morning star you could buy. So you measure from here to here, 160 pips or 16 pips, actually 16 pips. So from here, the breakout, 16 pips would be about here. So your target should be around here. Your stop loss should be below the shoulder. This one, that's your stop loss. So your stop loss is like what? Stop loss is about 6 pips. Very good. That's a good setup also. That's a very good setup also. So those are head and shoulders, and there are numerous examples in the textbook. So kindly find time to look at them. They will be helpful to you. The other pattern is we call it the W and the M, the mullahs and the mummies, the whammies and the mullahs, double tops and double bottoms. So let me draw that for you so that you get it right. Market is moving up, stops, comes down, tries to go up, stops, comes down. It creates something that looks like an M. How do you trade it? When we break below this level. This is a double top. Top number one, top number two. In other words, it has made the same high twice.
Mm.
That tells you the uptrend is not going to continue, most likely. Remember, the logic has always been, if the market must continue up, it makes a high, makes a higher high, makes another higher high. So if you see the market can't make another higher high, it tells you the market is not going to continue that route. We say the uptrend is tired or weak.
Mm.
So that's the logic behind that. So if you see the market go make a high, come back, make the same high, come back, that is simply a double top. And the market, if it breaks below this level, it will continue down. It will continue down. The opposite is the market is coming down, makes a low, goes up, makes another low exactly at the same level as the previous one, then goes up. Assumption, if it breaks above this level, it will continue going up. This is a W. The W is a double bottom.
Mm-hmm.
Bottom one, bottom two. What do we know about the downtrend? Market makes a low, and another lower low, and another lower low, and another lower low. That's when we keep a downtrend. But this one made a low and made the same low after coming from lower lows, telling you the downtrend is now weak. And when the downtrend is weak, we start what? An uptrend or a range.
Mm.
So let's see whether you can spot. These are easier. They're everywhere on the chart. These are easier to spot. They're easier to spot and they're almost everywhere. So let's see whether we can get some. Okay, let's move. Okay. Sometimes they're just perfect. You just look at them and you, oh, perfect. We go back to 1 hour. Here's an example. A high. I'm looking at the bodies. High, break below here, market goes down. That will be a double top, but not the kind of double top I want you to see. I want you to see a double top that's quite clear, like here. Look at these two tops, this and this. They're almost at the exact level. This ones. Went up, came down, went up back to the same level, came down. When they break, when the market breaks below the point where they started from, like here, this candle that broke that level, after that the market continues down. That's a double top. For a double top, you just need to see a resistance. The market stopping there, coming down, stopping there, coming down. So resistance number 1, resistance number 2. Or maybe actually what we call this is top number 1, top 1, top 2. That's a bearish signal. It means the market will go this route. Okay, so let's see. Examples. Look at this. The candle stopped at the exact levels. Top 1, top 2. When the market broke below this swing, market continued down. Double bottom is here. Market comes down, stops here, bottom 1, goes up, comes here and stops here, bottom 2, goes up. When it breaks above this level, here, it continues up. Came back slightly and continued up. Another one, the bottom is here. Market stops here, goes up, stops here, goes up. So if the market was able to break above here, we would buy. Another bottom here. This is an example of a triple bottom or a quadruple bottom. Bottom 1, bottom 2, bottom 3, bottom 4. So when the market closes above the highs of these two, because look at it this way. So if you look at what we are doing here, you'd see there is this resistance here. There's this resistance. No, because I think the resistances are not at the same level, we could move the resistance to where most of the levels are here. So because then we can have this as resistance, as resistance, as resistance, as resistance. So when this candle closes above that, we can buy. One more example. We close that section for double tops and double bottoms. Or we can also look at the textbook examples. You see, comes down, bottom 1 goes up, comes down, bottom 2 goes up, breaks above the neckline. You measure the distance between this place and one of the bottoms, that becomes your target. This is the opposite, going up, makes one high, comes down, makes the same high, breaks the level, goes down. You measure the distance from here to here, that becomes your target down here. Okay, let's see. Head and shoulders, you can see that. This is head and shoulders. Head 1, shoulder 1, head, shoulder 2. Break and continue. See that? Hello?
Hello?
You can see that, head and shoulders?
Yeah. Mm.
I think there's another one here also. First head, first shoulder, head, second shoulder, break, come back, test, and continue. There is a double. Let me show you another double bottom or double top. We'll find one quickly. Double bottom is here. Stops here, goes up, stops here, goes up. Breaks above the neck. You know, after it reverses, it creates a resistance, comes down to the, so it becomes your neck. After it creates the first bottom, it goes up. Where it reverses from, that becomes your neck or resistance. Whenever that level is broken, you can now consider buying. So you only measure the height of any of the bottoms. This is at 7. So after the breakout, measure at 7. Market should be stopping somewhere here. This is an active trade, so market should close here for you to have won that trade successfully. So I think that's how we look at those charts. Now remember, after the market has broken up from a zone, it can still come back. Like we have said, it's a double bottom. A double bottom in the sense that we have bottom 1, we have bottom 2, we have our neckline here. So when the neckline is broken, it can break and you enter trade immediately, or you wait for a pullback. Now this time around, the market was careful enough to give you a pullback. And there's a morning star, there's an inverted hammer here. There are many candlestick patterns you could use here to enter a trade again. So if you entered from here, you can also enter here or just maintain one trade, depending on your trading plan and risk appetite. So after that, which is the other pattern? Triple bottom, the same thing. Now a double top makes top bottom, a double bottom makes bottom 1 and bottom 2. A triple bottom would make first, second, and the third. Still the same logic. Once the neck is broken, you go up. A triple top is the same thing. Makes one top, makes second top. Now this time makes a third top before breaking the neckline and going down. So remember, when we say a double bottom or a double top, we normally talk about this one and this two only for a double top. But a triple top will make another peak. If you thought of a quadruple top, then the market should reverse from here and then do that. Then that will be peak 4. Sometimes the market can do many of these things, peak 4. The logic is, this one is not very common. Triple top is not very common. Triple bottom is not very common, but double tops and the double bottoms are very common. Is there a pattern I've ignored? I think those must be all. The 9 patterns you need to be aware of. Where were they listed? Yeah. I think if that is the case, we have handled symmetric triangle, ascending triangle, descending triangle, inverted head and shoulders, double top, double bottom, triple top. Those are 9 chart patterns that we have looked at today. And I think there are 9, yes. So that brings us to the end of this pattern. That brings us to the end of that section called chart patterns. Now, if you ask me, among the chart patterns, the 9, among the 9 chart patterns, I will tell you this. If you want to trade chart patterns, concentrate on this. These are the ones I find that are very profitable. Concentrate on this. This is my only recommendation. This double top and double bottom, head and shoulders, only those. If you must trade 1 or 2, then trade head and shoulders plus the inverse head and shoulders. They're the most accurate of all the 9. Head and shoulders and inverse head and shoulders are very accurate with more than 70% accuracy. If you find them and you are able to trade them. followed by, I think, double bottoms and double tops. Now, remember, these ones are rare, but if you find them, you can trade them. Triangles are tricky. Triangles are very tricky. You would see a triangle that looks like this. Market breaks above and immediately comes back down and breaks below the next one and then goes back inside. So those who entered up, they have lost. Those who entered down, they have lost. Then the market continues in a range. Spikes up and you think, okay, now they are breaking out and comes back inside. Triangles can be crazy, I tell you. But I'll show you how to trade them profitably. They're not bad. I'll show you how to trade them profitably with the volume analysis. So then up to that point, I believe this is how far we are. So let's go to measure progress. Where are we? We are here. Done, 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 done. Okay, so what's remaining is for us to talk about divergence trading. So what we'll do tomorrow, which is Monday. Tomorrow, which is Monday. my tomorrow is Monday when we're talking about our work is Monday. So we'll combine these two as well. Divergence trading and the Bollinger Band squeeze. As a matter of fact, this is a strategy. A very profitable strategy. This. Number 11 is a strategy. Divergence trading is a strategy as well. Okay. So I'll combine these two in one session. So we'll have covered one strategy, then we'll see whether we cover a few more later, strategies later. We have, we'll spend time looking at Confluenc trading, but I've already mentioned something about Confluenc trading. And this is what I was saying. If you have a support, you have a moving average at the same level, you have an uptrend, you have a trend line, and you have a candlestick pattern forming around here, and if Fibonacci something, you take a signal, that is a Confluenc signal. And those are the most powerful signals you can ever get from the market, I will tell you. Look at that. Let me show you. Confluenc trading, I've shown you in advance without telling you that we are talking about Confluenc. Let me add my 50 EMA and 100 EMA. All right, like that. So after I've done that, I think let's go back to a higher time frame, 1 hour. So what I need to do now on my time frame is to do this. Let me draw my levels. I think those could be about the levels. So we are moving in a downtrend. What do we say we do in a downtrend? We sell. Where do we sell from? At resistance. So a downtrend starts here. We had a previous resistance. We can still use it as resistance. We can use resistance as resistance or broken support as resistance. Those are the two you can use. Resistance or broken support and the market coming back to it. Now this time again acting as resistance. So long as the candles are below the level that is resistance. Are we there? So market comes back to your resistance. What do you see? You spot a shooting star. What does a shooting star at resistance indicate? The market will go down. A shooting star after the market has gone up means the market will go down. Where is this signal? So I want you to see why this is Confluenc trading and why it's very powerful. Confluenc trading. This one we say convergence of many identical signals, where many things are saying the same thing. Now, here, number one, let me explain to you the reasons why that's powerful. Okay, we see this candlestick pattern at resistance. Then we try to see, were we having any trend line before? And sure enough, when you check on the chart, you spot there was a trend line. There was a trend line here. If you follow this touch, this touch, this touch, that's a trend line. Now, what else do you see? Fibonacci. Can we use Fibonacci here? Yeah, you pull Fibonacci from here. Market started from there, went down to this level. Soon enough, this pattern is forming at 61.8. Wow. Where is the pattern forming? At EMA 100. Now, this is Confluenc trading. Let me show you why. That's why that's a good signal. Number one, we have resistance. We have resistance, horizontal. Number two, we have resistance, diagonal, which is the trend line. Number three, we have resistance, dynamic, which is what? EMS, because price is trying to break the EMS. We have number four, Fibonacci, Fibo 61.8. We have number five, shooting star. Those are 5 things saying sell, sell. Finally, we have the most important, downtrend. So a downtrend tells you sell. A shooting star in a downtrend says sell. If market retraces to 61 or 50 or 38, that's a signal to sell. If market is at resistance, sell. If market is touching or rejecting a trend line, like here, this shooting star is rejecting the trend line, sell. If the shooting star is rejecting a moving average, like you see, market is trying to break through the moving averages, sell. So 6 things saying sell, that's a very powerful signal, and that's what we call Confluenc trading. As a matter of fact, let me introduce something else. Let me see whether this will also add value. Remember the sweet spots I sent you. Let me drop it here. Maybe it will give us around the number around there. See, round number, you see? The blue line. That's a round number. That means the shooting star is rejecting a round number, it's rejecting Fibonacci 61, it's rejecting a trend line, it's rejecting a moving average. We are in a downtrend. Now we have 7 reasons why we should sell. Okay, let's see whether we can have the pivot points. Drop the pivot point here. Was there a pivot point around there? Let's see. I put too many things here. Let me clear some. I think this is still the round number thing. Sweet spots, go away. Pivot points, that may not give us until I expand the number so that it can give us to the past. Yeah, almost, but that's a bit far. That's a bit far. Does it allow you to show the midpoints of a pivot point? The center midpoints. Yes, that could be the one. You see? Rejecting a pivot point as well. That's Confluenc. I mean, you have now 8 reasons why you should sell. So that is what you are calling Confluenc trading. There's nothing magical about this. And as a matter of fact, I can add another filter. I can add a Bollinger Band to show you that maybe this kind of is also rejecting the upper Bollinger Band. You will be surprised. You can add too many things. You don't have to add all of those, but they can give you more confidence when you're trading. Default bands, Bollinger Band, most likely is rejecting the upper line. Exactly. This candle is outside the upper line. The upper line of our Bollinger Band is resistance. The lower line is support. So this candle is outside the Bollinger Band. And when outside the Bollinger Band, the suggestion is the market will go back into the Bollinger Band. So you see? Now, that's reason number 9 why you should sell. That's the Confluenc.
That's an analysis that you do in the morning. You do when you want to enter a trade.
Sorry? Ask that again.
That is what you need to do every time that you want to enter a trade. That's what you do, the analysis.
Or when I'm trading?
Yeah.
When I'm trading, I put as many things as possible to just be sure the trade is good. Yes. You put all the knowledge in. I've not even added... sorry?
All the knowledge that you have.
Yeah. You don't, I told you at the beginning, you only need three things. Number one, you need to ensure the trend is correct. Number two, you need to ensure you are trading at a level. Our level is support and resistance. Number three, you need to have a candlestick signal. In this case, we have a shooting star. Those three are the bare minimum.
Okay.
Even with those three, you can enter trade, surely. You will win most of the time. But when you want to be too sure, you just, satisfy yourself. You can add in those parameters, those others. You can add in those others. Okay? Just to feel much more confident we were here. And maybe if you feel like that's not enough, you can add an indicator that to tell you maybe price is overbought or oversold. If you put a stochastic here, it will be above 80. See, sure enough, stochastic is above 80.
Above 80.
Look at that. When stochastic is above this line, 80 line, it means the market is oversold. Oversold means it's too overstretched. It should be going down.
Okay.
So this one is saying oversold. Oversold means sell. Because after stochastic is up here, the next thing you see is it goes down. And the market, remember, stochastic is following price. So like it was up here, the next thing, price was up here, the next thing, price went down with it. When it's down here, it says the market will soon go up. Sure enough, market goes up. So stochastic saying oversold, please, overbought. This is called overbought, this is called oversold. So overbought, market goes down. Okay? So you can add that if you wanted an extra filter. So there are really many things you can put there. Okay? There are very many things you can put there to ensure that you are feeling happier or much more confident. You can add the volume. We'll talk about volume later. You can add the volume. And what is the volume saying? Volume is saying this is a no. What is this? This kind of, this is a pseudo upthrust candle. Pseudo upthrust. That is a reversal signal from volume analysis. It's a reversal. Because the market has been going up, it's a reversal that the market will go the opposite route, which is down. So volume is saying sell also here. So there are too many things saying sell. You should sell. That's why you made a proper choice taking a course, because you are not going to learn all these things combined online. I will tell you for free. You will not find them anywhere.
Okay.
Even those free courses you see, people will teach you some support and resistance. They will never tell you how to mix all of these things in a trade. So that will be fine. And I think when we talk about strategies, I will give you those more of this. When we talk about strategies, the 5 power price action strategies, they all follow Confluenc trading technique. Because Confluenc trading, it means bring in as many things that will support the decision you are taking. If you want to buy, let them tell you buy. Each of them will tell you buy. Then you'll be more confident to buy. So I think we can stop it at this point. We have taken close to 2 hours.
Yeah, 2 hours.
Yeah, which is good. I think we'll just finish the course earlier because now we are spending more time each day. So I believe tomorrow, if we talk about, God willing, that's Monday, we talk about divergence trading, Bollinger Band squeeze and spike. That's a trading technique. Then later on, we talk about the strategies for 2 days, money management, and we close. So we have like 4 more days or 3 more days, depending on how fast we move.
Thanks.
All right. So any questions?
So far, not yet. I go back. I go back to the notes. If you have a question, I will go back to you.
Yes. And I've shared a number of materials with you. Spend time with those. The video is uploaded, has come to you. Read this book nicely. Okay. If you have a challenge with deciding how much you can invest, I sent you a lot calculator. This is how this thing works. It's good to know how it works, although I was going to show you later on when we talk about money management. If you have an account, let's say you start an account with $100. I'm not saying you start with $100, as just an example. Of course, you can start with 1,000 or whatever amount you have. If you have an account with $100, never risk more than 3%. Never risk more than 3%. So if you want to use 3% per trade, it means the maximum you can lose on that trade is $3. The maximum you should lose on a single trade, if your account balance is 100, the maximum you should lose on one trade is $3. $3 is 3% of $100. Now that means if you are buying and your stop loss, you can put your figures here and see what the calculations would be like. Like now you are in Euro USD, this Euro USD 1 hour. If your price is here, now like the price is currently somewhere here, where the red candle is at the moment. So if I copy this price, the current price, and give it to my Excel. So I want to say buy. So if I want my entry price to be here, because that's where I'm entering from. Do you see what it just did below here? It was saying lot size 0.3. But now when I put my entry as this, okay? When I do this, then it's saying my lot size should be 0.01. 0.01. And I need to give it stop loss. I need to identify my stop loss. So if I'm buying from here and I feel my stop loss can be here, what is that? This line. If this is my stop loss, I can copy it and paste under stop loss here. Good. And I feel like my target could be above here. My trade should close around there so that I make more money than I'm losing. Then I can put my TP here. Then this guy is saying your lot size should be 0.03. For any pair that's 4 to 5 digits, this one is 4 to 5 digits, as you can see, after the decimal, 5 digits. For one that is 3 digits, like JPY pairs, you use 3.03. So here, 0.03 for Euro USD, for example. So exactly here, that's where you say 0.03. 0.03. That's what it means. Now from here, you can buy, you can sell. So we talk about this. So these tools are important. I'm sharing them with you, not because you asked, but because I want them to help you. So I'll be identifying important things and sharing them with you so that you can also benefit from the same. This book is very important. In your free time, you can read it. I compiled it personally before I started seeing them. I was on the website. I read this website myself when I started. So I could read, copy paste, and I created my own PDF. So I'm sharing that with you. As you can see, compiled from babypips.com. It's not my own work. I compiled it. So I respect the source. I'm giving credit to the source because it's not my work. All right. But it's a nice material that you can give reference to, because from here you can learn some of those concepts that you probably may not be able to get. Here we talk about currency pairs, for example. These are the major pairs we trade, these ones, and their names. Okay, these are the market hours. Sydney market, Tokyo market, London market, New York market. When you should trade which pair. Tokyo session, this is Japan session. What pairs should you trade at that time? If you trade the London session from 10 a.m. Kenyan time to 7 p.m., what pairs should you trade? You look at that kind of things. I was trying to get as much information as possible, which are the best days to trade. Tuesday, Wednesday, and Thursday, definitely. The best days to trade. Tuesday, Wednesday, Thursday. Friday is volatile because people are going to close and head over to the weekend. Monday, because market has just opened. Market has just opened on Sunday, Monday, midnight, hapo katikati, So you expect anything to happen, okay? So then we look at the technical analysis, fundamental analysis, what they are, the 3 pillars of market analysis. What we are doing is technical analysis, the most important, technical analysis. There are those who trade on news only. They are called fundamental analysts of the fundamentals, fundamental traders. We are technical traders. There are those who trade sentiments. Sentiments, there are people who trade opinions. When they hear, euro is not performing very well, it might be a weak currency. Just based on those kind of how people think they would trade, right? So you see, I've documented so many things. Candlestick patterns are also here. Tweezer bottoms, tweezer tops, evening star, morning star. A very nice resource even for you. Double tops and double bottoms are here. All of those chart patterns we were talking about, they're here. Double top, double bottom, here. You see? You see? They are the same images that are also in the other ebook. You know, people like reusing the same thing. So this is a very nice material. Pivot points we are talking about, they are also here. Think. Resistance 3, resistance 2, resistance 2 pivot points. And how you should trade this. So do not ignore anything I share with you. Place it in your folder. Refer to it later. Okay? Otherwise, let us end it here. And thank you for attending the session. See you in the next one. God willing.
Thank you.